pushback to the SEC's new model to track hedge funds investments is growing louder. Shocker. In an appeals brief filed late Thursday, Ken Griffin, Citadel Securities, says the new rules are a threat to privacy and civil liberties that have, quote, set off alarm bells across the political spectrum. However, the commission created this Big Brother regime without any approval, direction, or appropriation from Congress. Our next guest says the agency's attempts to fix past mistakes will likely lead to excess volatility in the bond market. Want to get more from Bloomberg Opinion columnist Aaron Brown. That's typically how it goes, Aaron, right? You fix one problem in the financial world and you create another one. What's really going to happen here? Like, take me beyond the hood of what's happening.
Well, sure. I mean, this rule now is sort of an outgrowth of 2008, when after 2008, capital requirements were increased, banks were discouraged from risk-taking. The registered dealers, especially in the government bond market, this is mostly about Treasury bond market, but it actually applies to all markets, had less capital to devote to it. So liquidity started being provided by hedge funds, by proprietary trading funds, high-frequency traders outside the SEC regulatory framework. And now the SEC is coming in and saying, okay, we want all those people to register as dealers, which means higher capital requirements. It means more disclosure requirements. It means stricter rules on the trading. I'm not sure I'd go anywhere near as far as Ken Griffin did about a threat to fundamental civil liberties, but it does make liquidity harder to provide. It means we'll have less liquidity. A lot of those organizations won't register. They'll stop providing liquidity to markets. And the ones that do provide liquidity will have to charge more for it to pay the cost of the regulation.
It also raises the question, Aaron, about for those folks who maybe still want to actually be involved in this, does it push more of this, or potentially, I should say, push more of this into the shadows, if you will? I mean, won't we just sort of get a new crop of players in this market that find a way to circumvent the regulations by basically doing it from the sidelines?
Yeah, well, you're moving the shadows, let's put it that way. The people who are now in the shadows will be exposed to bright light, and so new people will, emerge from the new shadows. Some of those people in the shadows today will move farther out. So yeah, we may end up having less understanding of how liquidity is provided and less ability to regulate it. If anyone knows, it's hard to tell.
So where does the shadow move? Private lending?
Well, there are a couple things you can do if you're under 50 million in assets. So we could get some, like the small high-frequency trading shops can continue unabated. Foreign financial institutions can do it. Public mutual funds can do it. So all of these people have exemptions and can get it. But if you're a big hedge fund, if you're a big proprietary trading fund, you can't escape. You either have to register as a dealer or you have to stop providing liquidity to the market.
This raises a broader question, though, Aaron, just about kind of, the staleness, if you will, of our sort of financial regulatory regime. I mean, most of what we have today is a direct outgrowth of either the Great Depression and some of the events that led up to it. I think we've had a few changes, obviously, in the post-World War II era. That's pretty much it. I mean, right at this stage, we're basically taking those original models from decades, if not a century ago, and really trying to tweak them for the modern era. Do we need a more major overhaul, or at least a more major rethink of not just who we regulate, but as to which agencies should be responsible for it?
Well, that's half of the truth is what you said. The other half of the truth is we've had enormous change, both in financial markets and their regulation. But what you're correct about, absolutely, is that the SEC has to shoehorn these changes into rules that were written in 1934, 1940, using vague terms like routine business. This whole thing we're talking about is a redefinition of what it means to be in routine business. It would make much more sense if Congress would take this up, hear from all sides, and come up with a modern regulatory scheme that made sense. But I'm not holding my breath for that.
Okay, so now what happens? What's next?
Well, the rule is there. It goes in effect in 60 days. I don't think it will be stopped, although Ken Griffin will probably try, and some of these other complainers might go to court or ask Congress for help. If it goes in, some of these, I think it's only going to affect maybe 50 or 60 firms. I don't think we're talking about something that, affect millions of firms. So half those firms, and just at a guess, half those firms will stop providing liquidity and half will register as dealers. We'll have less liquidity. We'll have, chaotic market changes. but I don't think it's going to destroy civil liberties in the United States.